Hi, I'm Phil Borkin from JB Were. Everyone knows the story of Goldilocks and the Three Bears. Now, putting aside the fact that she's a criminal and probably should be locked up for breaking and entering, the story is really about her tasting different bowls of porridge and preferring the one that's not too hot and not too cold. It was just right. You may be wondering, what has that got to do with financial markets and investing? Well, just like Goldilocks and her porridge, financial markets and equity markets especially prefer economic conditions that are also just right. The healthiest returns typically come when economic conditions are neither too hot nor too cold. So not too hot as in capacity pressures are building up, creating inflation that the central bank might need to do something about, and not too cold that growth's soft, unemployment's rising, and corporate profitability is deteriorating. It's not the case everywhere at the moment. In New Zealand, for example, the economy's clearly feeling the strain of earlier monetary policy tightening, and we expect those challenges to last for a little while yet. But in the all-important US economy, which has a very large bearing on where global financial markets and local financial markets go, it has very much been enjoying Goldilocks economic conditions over the last 6 to 12 months. Growth has been strong and better than expected, at the same time as inflation has come down meaningfully. So much so that the central bank, the US Federal Reserve, is now contemplating when it might be able to cut interest rates. So if you think of that, that's a far less threatening economic backdrop than investors have had to grapple with for the last few years. So instead of concerns over persistent inflation, sharply weaker growth, and really unfriendly central banks, we now have an environment, at least in the US, of better than expected growth, lower inflation, and maybe even lower interest rates at some point. And throw onto that the performance of some of the largest tech or tech-like companies that they've benefited from excitement around artificial intelligence, and it's really created an environment for quite healthy investment returns over the past 12 months or so. But where to from here? Could those healthy investment returns continue? Now, we think it's quite likely that the Goldilocks benign economic conditions that the US economy is enjoying can continue. The trouble for investors is that markets think so too. It's very much become a consensus view that's now reflected in asset prices. So with that in mind, what we're asking ourselves constantly is, where could we and the market be surprised? Remember, large asset price moves don't occur at random. They occur because there has been a surprise. And I think we can all appreciate there has been plenty of those over the past few years. Whether it was the COVID pandemic itself, the inflation shock that came on the back of that, or more recently, the better than expected growth in the US economy. Those surprises, positive and negative, have created large asset price moves. So where could that surprise be? We don't know. No one does. But I think investors would be wise, given how unusual this economic cycle has been, to keep an open mind on where the US and global economy is heading. Indeed, I can think of quite plausible scenarios where the productivity benefits from AI start to drive better growth outcomes and even higher equity markets from today's levels. Equally, there are some downside risks. That last mile of getting on top of inflation might prove to be the hardest, and there's certainly some evidence of that more recently in some economies. It might just be that interest rate hikes are just taking longer to have an impact on the US economy. And in time, the growth slows just as it has in places like New Zealand. And of course, the geopolitical landscape is clearly pretty turbulent at the moment. That brings with it some obvious risks. So when we think about the benign Goldilocks scenario that's our central case, it's the risks around that we're most mindful of. And we do still think they have that downside skew to them. So we're not negative, but we're cautious. So how is that view reflected in what we're doing within the MAS funds? Well, first and foremost, we think there's attractive risk reward on offer in fixed interest asset classes, especially domestic fixed interest. Not only are the higher levels of interest rates and bond yields now providing that defensive source of return, but also as interest rates eventually are cut, which we expect to see later this year, the potential is for some capital gains to occur in those bonds as well. Within equities, we prefer companies and investment themes that are more resilient to the economic cycle. These are typically companies that might have strong balance sheets, good free cash flow generation. They might have moats around their business models that allow them to enjoy above market profit margins. Most importantly, they often have large cash buffers to allow them to invest in some of what the world's seeing these exciting themes at the moment, whether it's artificial intelligence or weight loss drugs, decarbonisation, cybersecurity, you name it, and the MAS funds all have exposure to some of those themes. The final thing I'll say, and you will hear this from many investment strategists, but it doesn't diminish its message, is that it can often feel all too hard, especially at the moment when you read the news and you see the turbulent state of the world. Sometimes you wake up one morning and just think, you know what, I'm going to divest, cash up, and look at reinvesting when things feel a little bit easier. Now, the challenge with that approach is that you're forcing yourself to make two very dramatic asset allocation decisions. The first might feel easy, the decision to sell. The second one, when to buy or reinvest in the market, is often not. There's often always something that proves to be that impediment. And you always have to remember, when things feel better, typically markets have already reflected that, so you have the potential to miss out on those earlier gains. Some of the best advice I ever was given when it comes to investing is to behave like a robot. Take emotion out of it. Easier said than done. Humans are emotional creatures. But rather than making dramatic asset allocation decisions, focus on your long-term investment goals and objectives. Stay invested, align with your appropriate asset allocation, and remain in the market. Trying to time it, history teaches us it's a pretty fruitless exercise. I'll leave it there. Thank you.